What if I told you you could buy an investment property without showing a single pay stub, W-2, or tax return? That's not a loophole. That's exactly how DSCR loans are designed to work. I'm Rebecca Foote of the Rebecca Foote Mortgage Team and owner at Foote Capital Mortgage Company. Today, I'm going to show you the full roadmap for using DSCR loans to invest in real estate in just 9 simple steps. You'll learn what they are, how to qualify, and how to use them to build a real estate portfolio. Let's get into it. Let me tell you a story about a borrower I recently closed on for a loan. They were looking at buying a 3-unit investment property. Now, this borrower has great credit, money to work with, and they're already an investor, meaning they have a number of other rental properties. We first looked at doing an investment property loan the normal way through Fannie Mae and Freddie Mac for him, but his debt-to-income ratio was too high, and he was going to have to bring $45,000 to the settlement table on top of his down payment and closing costs just to bring his debt-to-income in line to qualify. That's when we suggested he look at doing a DSCR loan. The interest rate was the exact same as the interest rate he was looking at getting on the conventional investment property loan through Fannie and Freddie. Except with the Fannie and Freddie loan, he was paying 1 point. With the DSCR loan, he was going to need to pay 2 points. But he didn't need to bring $45,000 to pay off debt. He didn't need to provide all the usual documentation that you would with a normal conventional loan, such as tax returns, W-2s, 1099s, current mortgage statements for every property he owned, proof of insurance and proof of real estate taxes for every property that he owned. And the list goes on and on and on. He was super excited to learn about the DSCR loan because 1, it saved him from paying off $45,000 in debt. 2, it saved him all the hassle of gathering all that paperwork. And 3, the pricing of the loan was virtually identical to the loan that we were looking at doing through Fannie and Freddie. It was a no-brainer, and he said he would definitely use that product again. Now, I know what you're thinking. Rebecca, what is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. The math is simple. It takes the property's gross rental income and divides it by the monthly mortgage payment, which includes your principal, interest, taxes, insurance, and HOA dues if there are any. So if the rent is $2,500 and the mortgage payment is $2,500, you take $2,500, divide by $2,500, and you get a ratio of 1.0. A 1.0 ratio means the rent covers the mortgage exactly. Here's another example. If the rent is $2,500 and the mortgage payment is $2,000, you take the $2,500, divide by $2,000, and get a ratio of 1.25. A 1.25 or higher means the property is cash flowing with room to spare, and that's your ideal target. Now, I'm going to add a side note here. Yes, you want the property to cash flow, so you want an ideal target of 1.25, but you don't actually have to have that to get a DSCR loan. I have investors that I can sell a DSCR loan to, even if you're under the 1.0 ratio. Now, here's the most important thing about DSCR loans. The loan qualifies based on the property's income, not yours. No W-2s, no pay stubs, no tax returns. It doesn't matter if you're self-employed, a high net worth earner, or someone whose income just doesn't look good and clean on paper. If the property cash flows, you likely qualify, because that's what a DSCR loan is. We qualify the property, we don't qualify the borrower. That's why these are called non-QM loans, which stands for non-qualified mortgage, and they're a game changer for the right borrower. Now that you know what a DSCR loan is, let's talk about the full roadmap for using DSCR loans to invest in real estate in just 9 simple steps. Step 1, know if you're ready. Before you start looking at properties, check 3 things. First, your credit score. We can do a DSCR loan down to a 620 credit score, but you really want to have a 680 or above to get better terms on the loan, and ideally 740 or above to get the best interest rates. If your credit needs work, let's make a plan before you start looking at properties. Second, your down payment. Expect 20 to 25% down. If a property doesn't cash flow at 20% down, be honest with yourself. It may not be the right deal. And third, your reserves. After closing, you need 3 to 6 months mortgage payments still sitting in the bank account. If your monthly payment is $2,500 a month, that's $7,500 to $15,000 in reserves. This protects you during vacancies and satisfies the loan requirements. Step 2. Find the right property. DSCR loans work for 2 rental types. Long-term rentals, meaning a lease of 1 year or more, and short-term rentals, like Airbnb. There's no in between. If you're planning a mid-term rental for traveling professionals, we structure it under one of these 2 categories, and I can help you figure out which one fits best. Eligibility property types include single-family homes, townhomes, 2 to 4 unit properties, and even 5 to 10 unit buildings if you have investor experience. Condos are possible and can be more complex. Also, think about your market strategy. Some markets offer great appreciation, meaning values climb year after year. Others offer great cash flow, meaning strong rental demand and steady income. Rarely do you get both. Know which one you're investing for, because it shapes everything about how we structure the loan. Step 3. Analyze the cash flow honestly. For the DSCR calculation, we look at rent in versus mortgage payment out. But for your own decision making, factor in the full picture: maintenance, utilities, property management fees, and insurance. These are real costs. You can go online and use Retrometer to estimate market rents for long-term rentals. You can use AirDNA for short-term rental income projections. Do your homework before you fall in love with a property. Ideally, you want to target a DSCR of 1.25 or higher. That's the number that gives you true cash flow after real-world expenses kick in. Step 4. Know your lender. Working with an independent mortgage banker like Foot Capital Mortgage means you're not limited to one bank's product. We shop multiple lenders to find the best combination of rate, terms, and closing timelines. And with investment property, closing on time really matters. One thing to know, DSCR loans often have prepayment penalties, ranging from 0 to 5 years. The longer the penalty you're willing to accept, the lower your interest rate. If you're planning to hold a property long term, a 3 or 5 year prepayment can actually save you money. If you might sell or refinance within 2 years, go with the no penalty option, even at a slightly higher interest rate. It's also important to note that some states have regulations regarding prepayment penalties, even on investment properties. Some states allow them and some do not. And some allow them, but only for certain multi-unit properties over certain dollar figures. Your lender will have to check on your exact situation. Step 5. Prepare your documents. The documentation is lighter than a conventional loan, but here's what you'll need: 2 months asset statements showing your down payment and reserves, proof of insurance, and HOA documents if applicable. We'll also need your driver's license. If you're purchasing in the name of an LLC, which many investors do, you'll need your EIN, operating agreement, articles of organization, and a certificate of good standings if it's an existing entity. And yes, we can do layered LLCs as long as the principals are identical in both LLCs. Step 6. Structure the financing strategically. You have more flexibility than most people realize. You can do the standard 30-year fixed rate, an adjustable rate mortgage with a lower initial rate, a 40-year amortization to lower the monthly payments, or even an interest-only option for the first 10 years to maximize cash flow early on. The right structure depends on your goals and timelines. I love this part of the conversation. Let's find the structure that makes the numbers work best for you. Step 7. Close and stabilize. Get a thorough inspection done before closing. That way, there's no surprises after you own it. Once you close, move quickly to find a qualified tenant. Mortgages are paid in the arrears, so you have a small window before your first payment is due. Use that time to get the property rented. Price rent competitively. Too high and it sits empty. Too low and you're leaving money on the table. Stabilization means a tenant is in place, rent is covering the mortgage, and ideally, you have a positive cash flow. Step 8. Monitor performance. Treat this like a business. Track income, expenses, and vacancies. Whether you're doing it yourself in a spreadsheet, you use QuickBooks, or you hire a property manager. Look for ways to grow income over time. Market rent increases, auxiliary income from storage or parking. Keep your expenses lean. Your performance data will matter when it's time to refinance or buy the next property. Step 9. Rinse and repeat. One property is a start. A portfolio is a strategy. The more properties you own, the more risk is spread out. If one tenant leaves, the others are still paying. Here's the system. Buy, stabilize, refinance to pull out equity if needed, and reinvest. DSCR loans work at every step of the cycle because personal income is never a qualification factor. You need credit, a down payment, reserves, and the right property, and you can build real, lasting wealth. There it is. That's the full roadmap for using DSCR loans to invest in real estate. This is how I buy investment properties, and if you're looking to do the same, hit the like and subscribe buttons so you continue to get more information like this. And if you're looking at buying your first investment property or your 12th, the link to schedule a call with my team is right below this video. If this was helpful, please share it with a friend who's looking to invest too. Thanks so much for watching, and I'll see you in the next one.